A 401k rollover is a process that allows you to move funds from your previous employer-sponsored retirement plan, like a 401k for example, into an IRA. Now, when you roll over your old retirement account into an IRA, you can preserve the tax-deferred status of your retirement assets without paying current taxes or early withdrawal penalties at the time of the transfer. Here to talk more about this is Kaden Wren with Prime Capital Financial in Scott City, Kansas. So Kaden, first, what are the advantages of rolling over your 401k?
Yeah, thanks, Scott. That's really a great question that I get from a lot of prospects and clients. Number one, in my opinion, is consolidation. There's a lot of people out there that have different 401ks from previous employers, maybe IRAs in different places, and their financial situation is just kind of spread out and they don't know where everything's at. So being able to really consolidate all your accounts into one, maybe two if you have a Roth balance, is very beneficial and just kind of simplifies your financial life. Beyond the consolidation aspect, within an IRA, you have a much wider array of investment options than you do in 401k plans, being, you have your typical maybe 30 different funds you can choose from in a 401k, whereas in an IRA, you have pretty much the entire stock market. You can invest in bonds or CDs. There's a wide array of options.
Now, are there any disadvantages?
Yeah, the main disadvantages would be look into fees. Occasionally, you can run into high fees with IRAs if you're with a bad advisor per se who's charging higher fees than it's worth. On that note, though, higher fees don't always mean it's a bad thing. If you're getting a higher rate of return that justifies those fees, well then, maybe that even makes sense in itself.
How can we avoid tax problems here?
Yeah, so when you go to roll over a 401k to an IRA, you want to make sure, first off, if you can just do a direct rollover, put it straight from the 401k into the IRA, that's the best route to go. That's going to automatically avoid any taxes whatsoever. Now, if the 401k custodian sends you a check personally, there's a 60-day clock that starts. When that 60-day clock starts, you have to get those funds put back into a retirement qualified account before the 60-day clock ends. Otherwise, it's all taxed as ordinary income, and that's a tax bill you will not want to pay at the end of the year.
What else should somebody consider?
I've seen it a couple times with some 401k plans is they have withdrawal limits or withdrawal rules to where you hit retirement age and you can't necessarily get access to your money as easily as you could in an IRA. Other than that, you just want to make sure your investments within those accounts, whether you leave it in a 401k or IRA, are good for your situation and matching up with your risk tolerance, your goals, and your investment time horizon.
My guest is Kaden Wren with Prime Capital Financial in Scott City, Kansas. Thanks for watching Retirement News Online.